So here's the first piece, is the problem comes up if you try to do a backdoor Roth IRA, and this is per spouse, remember, not per household. Per spouse, if you have an IRA, simple IRA, those both qualify. Simple IRAs don't count as an employer-sponsored plan the same way 401ks, defined benefits, money purchase plans, all that stuff would qualify as, okay? So it's simple IRA or IRA. If it's got IRA in it, it's going to count. Now, if those contributions were made pre-tax, you are going to have to pay some portion of the taxation on the entire account on a pro rata basis. So I'm going to do my best to explain this actually using a graphic from a blog of a gentleman named Michael Kitces, who actually does a majority of his writing and podcasts are to advisors, not to individuals. So he's not always the easiest to understand for a regular consumer, but he does a really great job. And thank you, Michael Kitces, for doing such a wonderful job of graphics every time you're posting something, so it really makes sense to people. So here is where, as an example, somebody tried to do a backdoor Roth IRA and what could go wrong. He's just illustrating it here. We have a $67,000 IRA, and that's all been funded pre-tax, either in contributions to an IRA or they contributed to an employer-based plan and converted it over. Then they made a $5,000 after-tax, non-deductible IRA contribution. That means that of all of their money that they have, 6.94% is after tax. So now we make a distribution. A distribution could be made like you're over age 15 and a half and you're taking a distribution in your old age. That could be a distribution. But it's also counted as a distribution when you move an IRA to a Roth. So if this same person with $67,000 pre-tax and $5,000 after tax, giving them an IRA worth a total of $72,000, we're to say, I'm going to try to do a backdoor Roth with this $5,000. What's going to happen is that only $347 of the $5,000 conversion to a Roth IRA is going to be tax-free, because the inverse of the 6.94%, effectively 73.06%, 93.06%, that's what I get for doing math in my head live on the show, is going to be taxable. So the backdoor Roth IRA, being able to do this without any income tax consequences, meaning you made the IRA contribution after tax, made the Roth conversion immediately after, does not work if we have other IRAs. It invokes this pro rata tax rule. And here's our bigger problem. Remember earlier I mentioned to you that you could be responsible or are responsible for keeping track of your basis when you made non-deductible IRA contributions. Now, Corey and I have watched over the years finding people that have accumulated, say, over 5 or 6 or 10 years, a bunch of pre-tax, post-tax contributions mixed with pre-tax contributions to an IRA. Some were rolled over from 401k, some were contributed. Here's the major problem with that, is that now you have to track that basis. And in this case, you created basis, but you have to also do the math of, oh, well, there was $5,000 that was after tax. We used $347 of it for the pro rata tax rule. That leaves us with $4,653 of basis that I can use later when I take the distribution. You can get a sense of how painful this could be.
I think there's only one person that I've met who actually had all the records. That's our very own Jeff Miller. And it still took him just ages to go put it all together to
my goodness,
usable. So best case scenario is you're going to spend a bunch of Saturdays coming up with everything.
Yeah. Best case scenario. And that was contributions he'd done over the prior 10 years. If and I think Jeff has said as much publicly, if he had not met us, odds are he wouldn't have known that. His records would have been too old and there would have been no way to track it down. By the way, if you're making distributions when you're in your mid-70s, do you think that is how you want to spend your weekends? Is trying to figure out how many non-deductible contributions you made to an IRA 30 years ago? Oh. So with that, this is the problem with the pro rata tax rule. We try to avoid it at nearly any cost, and it's okay to not be able to do this. It's just that if you do qualify to do the backdoor Roth IRA, you should do it every chance that you get because the compounding capacity is amazing. I'm going to just pull up a very quick time value money calculator to give you guys a sense of it. I don't need to run two of them. I'm only going to run one. But I want to give you a sense of how big of a deal this is. If somebody has the ability to do $6,000 a year to an IRA for 30 years and they get an 8% rate of return over that period of time, that would be a total of $734,000. And if we could do it for both spouses, again, the IRA contributions increase a little bit every year. Although, for the sake of this conversation, we're just saying $6,000 a year per spouse for 30 years running. That's almost $1.5 million. It could be in an IRA. But if it's in a traditional IRA, how much that belongs to you? 65%? Because that tax liability moves with you through time. Unlike a mortgage that gets slowly paid off over time, it's much more like a shadow that you cannot outrun, that tax liability. And the only difference is how you behaved on the front end and whether or not you could do a backdoor Roth IRA, because then it's the exact same number of 1.468 million, except it's tax-free. That's the power of doing this. It's super small on the front end. It's super big on the back end. I hope you enjoyed today's video. Thanks for watching. Be sure to subscribe to our channel, ring that bell, and by the way, make sure to share this video. I don't know if you know this, but my cyborg body runs 100% on YouTube views and likes. Please don't let my batteries die.